Hey folks, welcome to another conversation on Business Redefined. As always, this is your weekly, most comprehensive look at the world of business, finance, and economics. Now, this is the big week. We are expecting the Treasury Cabinet Secretary to go and present the budget for the FY 25-26 in the National Assembly on Thursday. That aside, we're expecting two other very important documents. The first one is a report coming from the Finance and Planning Committee on the public participation on Finance Bill 25. So what happens in that report is that they tell us this is what you guys submitted and these are our recommendations to the House. The second one is we are expecting to see supplementary budget 3 for the current financial year. Just 3 weeks to the close of the financial year, the National Treasury is expected to make public supplementary budget 3. So this week is quite loaded. And guess what? We want to unpack all this with Churchill Ogutu, Chief Economist at IC Group. Karibu sana, Churchill.
Asante sana.
Welcome on board, Churchill.
Thanks.
We saw the report coming from the Budget and Appropriations Committee of the National Assembly on the estimates for 25-26 being tabled in the House. Expenditure is going up from my math to about 4.3 trillion shillings. Revenue target is also going up, albeit marginally, to about 3.38 trillion shillings. What do you make of this?
Thanks. So even looking at the numbers that came from the Budget and Appropriation Committee, the initial numbers were tweaked slightly higher by 8 billion. This is on the judiciary and the legislative estimates, for the simple reason that these estimates were not initially tabled by National Treasury, but rather by respectively Judiciary Service Commission and also Parliamentary Service Commission. So there were some tweaks on those numbers. So getting into the numbers that you saw from the Budget and Appropriation Committee, there was an increase on the spending by around 32.7 billion Kenya shillings. This is now to the estimates to the national government budgetary allocation. So, and we've seen this play time and again, that the National Treasury estimates, and then there's some tweaks even that is coming from the Budget and Appropriation Committee. And also remember that there are also 235 billion unfunded requests that had not even been considered. So you can pretty much get where the 32.7 billion increase is coming from. Probably they just prioritized out of this and then they left aside this 235 billion unfunded requests. The other thing which was interesting this time around is now the publication of the estimates of revenue, loans and grants. This document, we never see it at
We
this
never
point
have
in time.
visibility of it, yes.
At this point in April, yeah. So that document came out, and also we saw the Budget and Appropriation Committee also weighing on the revenue side. There was an increase from of ordinary revenue by 11.5 billion to 3.328 trillion in the next financial year. I found it quite interesting because they did not comment further about it. Probably it speaks to either they have seen the baseline revenue. By baseline, I mean the ordinary revenue stock excluding finance bill, and then they have probably just seen a reason of tweaking it higher. The other possibility is probably they've seen some on the finance bill that probably they could be able to accumulate an additional 11.5 billion, but probably we will be able to get to see these insights as and when we see the Finance Committee report. But as it is, those are some of the things that came out. Increase in spending by 32.7 billion, revenue increasing by 11.5 billion. So that means also financing on the borrowing is increasing by rather 21 billion thereabout.
But Churchill, let's walk back. You spoke about the carryovers, and this is what I thought to be very interesting in the report which came from the Budget and Appropriations Committee. I would have imagined that supplementary budget 324-25 will take care of carryovers, and we see 25-26 almost beginning from a clean slate in terms of the next financial year. It looks as though there's a way in which we might see a further spillover into the budget for 25-26. Did you have the same inference?
I think there's that possibility in the sense that on the supplementary 3, it now deals with some of the spending that have already been incurred under Article 223 of the Constitution. So that obviously should necessitate a supplementary budget coming in for the current financial year. But then if you look at the Budget and Appropriation Committee, this additional spending, it speaks also to the interaction with the different departmental committees. For instance, the number that caught my eye was the 13 billion increase in the Ministry of Defense. So that came through the departmental committee that is dealing with the Ministry of Defense. And we know that this particular docket would never have some visibilities, but that obviously came out quite strongly that they accepted it. So it means that even if we are talking about the carryovers, we also have to look at how is our current financial year performing. We've seen even the first 10 months from July last year to April, revenue underperforming it by 253 billion.
I thought that was really large.
That's quite staggering.
Yes.
And also on the financing, there's some monies that was expected from the World Bank that's also not coming in. So if you look at the implication of this lower revenue, also this financing not coming through in the current financial year, it has implications on the spending side. So there is a possibility of either the monies that is not disbursed in the current financial year now being prioritized as carryovers in the next financial year, or some of them just falling off the cracks as we've seen in the previous budgets.
But Churchill, speaking about external financing, and when Parliament resumed on the 27th, their priority business was to adopt and approve the recommendations which came from the President when he sent the conflict of interest bill back to the House. Now, this was a very important development, because the reason why the World Bank's $750 million has been delayed is because of fallout over the conflict of interest bills and the provisions. Given how Parliament accelerated its adoption and passing on the floor of the House, do you anticipate that we will see now the World Bank board sitting down and we see the 750 million being unlocked before the close of this financial year?
I think that will be a long stretch. We've been seeing the executive board calendars from the World Bank. They've been publicizing that over a 3-month horizon. It's just that of late we haven't seen an updated calendar. The last one that we saw is as of March, which is just giving us visibility. The executive board calendar meetings between the months of March, April, and May. So as it is right now, we don't have visibility on what will happen in June. But having said that, considering that they prioritize it in a 3-month horizon, and because it was benchmark on conflict of interest bill having been passed, and this is just a recent phenomena, I don't think that they can now come again and prioritize it in the next couple of weeks. And even if, for argument's sake, we say that they prioritize that particular disbursement of $750 million, it might likely come in the final week of June and disbursement the first weeks on July. So I'm not quite optimistic that we'll be able to see that particular disbursement in the current financial year.
Churchill, when this financial year 24-25 started, I remember the fiscal deficit to GDP was at 4.3% of GDP. You and I sat down and had a conversation. We said this thing will likely close at about 4.9. We are at 5.1 as at supplementary 2. Supplementary 3 is likely going to increase it further. 2 questions here. 1, where do you see this closing in? 2, considering we are in the process of chasing a successor program with the International Monetary Fund, which the government is really keen on getting a funded program, they have made it public. Don't you think this again complicates the whole conversation with the fund?
Okay, so to the first question around where the fiscal deficit will be, I think we just use 5.1% as the ideal 5.1%, but then with a band of around 0.2%, so you're looking at around 4.9% to 5.3% thereabout. But all obviously benchmarked on where the supplementary 3 will be, but that will have some bias upwards. But also the offsetting bit will be on the spending, because I still feel that some of the spending will absorption hasn't been 100% over the years, and that will not even be different this time round. So that will be a neat offsetting factor. So the expectations around 4.9% to 5.3%. So with regards to the fund engagement with the successor program, I think we've had these debates time and again. So if at all we are looking at the fiscal deficit for the next financial year as a benchmark of as the deal maker to the successor program, I think we'll be in for probably some bumpy ride in the sense that even the next financial year, the initial estimates was 4.3%. We've seen some tweaks here. So even based on the Budget and Appropriation Committee, so there's an additional 0.2 percentage points increase in the fiscal deficit. So the math is quite interesting, even amidst the discussions. And also, it's not just about the fiscal deficit, it's also about some of the reforms that the government is quite keen to pursue, even in the next, in the event that there's a successor program. If you look at it from the economic classification, this is now use of goods and services, wage compensation, the transfers. You find that transfers, this is now transfers from the government and now to the implementing agencies is right about 1.3 trillion, which is 56% of the total budgetary allocation. So that speaks even to some of the reforms that the previous IMF program had emphasized on, structural reforms on parastatals. So is the government willing now to pursue those kind of reforms? So I think it's quite a holistic game, the engagement with IMF, but as it is, I'm still seeing that we are likely not to have a funded program, a meaningful funded program. We can have a funded program, yes, but it could just
But
be
the envelope will be so small.
It could just be a signaling program, as opposed to something which is much more meaningful. Yeah, so that's it.
But actually, I take a different view because when I sat down with the Treasury Cabinet Secretary and the Governor of the Central Bank on the sidelines of the IMF spring meetings, the tone was very bold that we will accelerate our payments to the fund to widen our scope for a tidy funded program. Essentially, we could front load some payments which should be coming down the road, and then we have a bigger envelope coming from the fund. We sat down in the Treasury CS last week, Churchill, and this interview went on air, and he said he kind of had a change of tone because now he was saying, even if we make payments to the fund, it won't really unlock much. I think that was a very important switch for me. And my thinking now is we could actually be looking at a non-funded program. I don't know what you think.
I think that's a possibility of an unfunded program. If you look at it, the base case as it is, the remaining disbursements in the month of March was around 68%, so less than $500 million. And this is excluding what we could have ideally have got from the Resiliency and Sustainability Financing, RSF program, yeah. So if we start tweaking ways of how to get a higher funded program, I mean, there are some limits, and I think that's even where the governor is coming, the CS Treasury is coming from, the limits of this. Because how can you get money to settle the IMF, and this is disbursements all the way up until calendar year 2029, yet probably domestically you have some domestic areas that are still pending. So I think that's the Damascus moment that the CS, CS Treasury for CS had, and now acknowledge that probably going forward we could have an unfunded program. And also look at it this way, having an IMF program is typically not for budget support purposes. Initially, even the creation of IMF was now for the balance of payments crisis. And if you look at from where we are, the current account, from a current account perspective, the re-exports and all these tweaks that you've seen, it is now showing that Kenya is in a much more favorable position.
Absolutely. It actually looks pretty tidy.
Yeah, as of February, I think we are negative 0.8% in the balance, in the current account payment position. You've seen the stability in the cash dollar. So that means that there is no risk of balance of payment crisis ballooning unless there's a shock that may come in. And the other thing, if you look at in the engagements with the IMF, looking at it from normal access or exceptional access.
But there is no case for exceptional access right now, Churchill.
There are 4 different criteria that has to be met. Extended balance of payment crisis, which is not there. The debt is to be deemed to be sustainable over the period of the IMF program. The jury is still out as to that. We also need, the third one is that the next program should have a higher possibility of success. Compare with the program that we came out.
We terminated in March.
The hurdle is quite high from the IMF perspective to ensure that reforms are done. But here we are. I don't think that there's a scope for that, and also that we can be able to get market access, which we've still been having. We've been going to do liability management operations. So exceptional access is out of the question. So I think the only way from the CS perspective and even from the market, non-funded program, that's the path of least resistance going forward here. Just to give investors that signaling that we're still having dalliance with the IMF.
Churchill, one of the things which you saw in the build-up to this budget in the recent past is it looks increasingly that mediation on equitable share will be a fixture, permanent fixture in our budget cycle. Treasury comes with the 4.5 billion.
Yes, yes.
The Senate says they want 460 billion. Now we're going into mediation. One, is mediation here to stay? Two, what do you see as the way forward around this? Because if we go for the 460 billion route, it has significant consequences on the deficit for the next financial year.
Absolutely. And equitable revenue is one of those rigidity items that we see in the budget. It's fixed. We have to pay. Similar with the consolidated fund services, the interest, the pensions, and all that here. And time and again, we've seen this movie before. National Assembly rather, proposing a different amount, and also Senate coming with a different amount. And also remember that we are tweaking even the ordinary revenue, because this split between what goes to the national government and what goes to the counties is basically from the ordinary revenue. But even from the Budget and Appropriation Committee has already increased that by 11.5 billion. So that also marks this whole water, because, okay, what will be the basis of the equitable revenue? So there could be a justification from Senate that, okay, ordinary revenue has gone up, why are we not getting a portion of that? So it's interesting times that is coming. But they need to sit down, these two houses, and also the Council of Governors, and also the Commission of Revenue Allocation, just to come up with a way of dealing this once for all. There's typically the formulas that keeps coming, I think after every 3 years or 5 years, from the Commission of Revenue Allocation, on the basis of how the counties will be able to get the monies. But ultimately, from the Senate perspective, it's like there's still some upward pressure to get higher revenue allocation to counties, justifiably, because there's some functions that are being executed at the county level and not on the national government level. So we haven't seen that full transfer of the functions. So yes, in as much as we get the ministries, department, and agencies getting a bulk figure, but ultimately the implementers are typically the counties. So I think that opens a bigger conversation so that we can now be able to see a stop to this tug of war that typically happens between the National Assembly and also the Senate.
Churchill, as we can now begin dialing down our conversation, one is that I've spoken to the National Treasury, and the indication is that Finance Bill 25, at the most ambitious, will raise just about 35 billion shillings in additional revenue. Compare that with the fact that if you look at the report coming from the Appropriations Committee, the ordinary revenue target has been scaled up. It is my expectation that further down the road, we will likely see either of two things. One, a supplementary budget which drastically rationalizes expenditure, highly unlikely. It's a likely scenario. It's a scenario we should anticipate, but it's highly unlikely. The second one is a further amendment laws on tax, similar to what we saw last year, 24, because the numbers don't add up. If you look at the budget estimates vis-a-vis what we are targeting in revenue, it looks to me like something is out of kilter here. I don't know what you make of it.
So let me start from even the macro backdrop around even the revenue assumptions. We are moving from nominal GDP of around 10.5%. The expectation is that will be a 19.3 trillion economy in the next financial year. So that's a 10.5%. So if you look at the ordinary revenue, the increase is nominal terms is around 176 billion, which is right about 6% increase from the estimates that we were in the current financial year. Whatever supplementary three will have, there's a likelihood that they will have to revise lower the ordinary revenue for the current financial year. So even the starting base will be quite high. So if you look at where finance bill fits in, so there's a gap of at least 176 billion. The indication is that the tax laws amendment and the tax procedures that came in December is likely now to have an increase of 70 billion in the next financial year, and then the 35 billion that is coming from Finance Bill 2025. So there's a gap of around 70 billion thereabout here. So it lends credence to a possibility of having another tax laws amendment or tax procedures 6 months down the line, because that's typically the time frame before another tax related law is brought into the picture. So that is the possibility. Having seen finance bill pretty much being a cleanup bill because of the strains that happened last year. So that is a possibility. Or now, as they start monitoring the revenue outturn, they could now scale it much lower to much more reasonable levels based on even the outturn of what will be in the current financial year. So that is also another possibility. Spending, obviously,
It'll be a sticky one.
is a sticky one. So who typically takes the bill is now higher borrowing.
Or development is slashed again.
Exactly. That's also another thing that typically plays out here. Funnily, this was another thing that also came out in the signaling in this budget is dealing with domestic arrears. Verification committee, there's some amount that was verified. So it's like now Treasury has also prioritized 229 billion, of which 80 billion road sector, and then there's the 149 billion that possibly could be sorted out in the next financial year, but typically below the line are now hinging on privatization. I'm still skeptical of the pipeline.
We wait to see. We've had that conversation before.
Yes, we'll wait to see on that, yeah.
Churchill, as we close, every Kenyan is wondering whether 25-26 we are looking at a Manchi budget. One is, what would that look like for you, a Manchi budget? And when you look at the numbers and the proposed allocation across the sectors, health sector taking about 134 billion, manufacturers have really complained about their prescribed allocation. Do you think we have a Manchi budget here?
I don't think so. If you look at it from the budgetary allocation, I don't think so. It's still business as usual. Yeah. So there's no tweak, there's no signaling that is coming from the budget that it will be a Manchi. The argument could be that, say, for instance, health has gone higher from a budgetary allocation, or even if you look at education, you can say it's taking the biggest chunk. Yeah. But still...
Of about 700 billion.
Yeah, 700 billion.
Yeah.
But this also is funded from taxes, and we've seen even some tax pressures to the health sector over the last 2 years, getting into the to fund. So yes, you can see that it's increasing, but flip it, there's some pain points to the expenditure increase to some of these budgets here. It may not be out, say for instance in the health sector, the SHA increase in SHA funding, because initially it was included in the budget, but this was never the case, even with the case of NHIF. And so they excluded it. I think it's around 73, 75 billion thereabout that is expected. So if you look at it that way, it just tells you that, yes, it might going towards a particular sector, but there's still some pain points that is coming out. The numbers that you saw from the economic survey, real wages has been tanking. So what is that pressure, what is that reprieve that we could see from the budget that could alleviate the pain points that we are for 190? So I think that's the big question, but I don't think that the budget F25-26 has addressed adequately those kind of strains that is coming out.
Final question, Churchill. I don't know whether it's me, and I've even written to the central bank about this, but we seem to have a delay in the June auction for the bonds. Are we behind schedule, or what could be at play here?
Interesting. And actually today, we got to see the monetary policy statement. Expectations before this monetary policy meeting was that it could be a hold, having seen what has happened in the previous MPC meetings. So there's been really aggressive in terms of ensuring that credit mediation is quite supported, reducing the benchmark rate, trying also to narrow the interbank corridor and also on the discount window. So now flipping it into the securities, into the domestic borrowing, what we have seen so far this financial year is that the liability management that was done in February has reduced the refinancing pressures in the months of April and May. If we hadn't done that, we could have been at a more precarious situation. So that one was sorted out, and I can tell that the Central Bank of Kenya, as the fiscal agent, is having that luxury of time. They don't have that pressure. Looking at the numbers of domestic borrowing, even from the quarterly economic budgetary review, it was way ahead of the curve by around 170 billion. And by March, and having reduced the refinancing risks in March, in April and May. So even coming to June,
there's no pressure.
There's no pressure at all. So that lends credence to the delay that you've seen in the June auction. But having said that, I mean, either it could be a tap sale that could come in, as has been the case. This fiscal year, we have not seen a new issuance whatsoever. It's either been reopening and tap sales. So probably with the luxury of time, and they would want now to bake in the supplementary 3 estimates, and that probably will nudge them either to a tap sale or a reopening towards the tail end of the fiscal year. So, I mean, luxury of time from the Central Bank of Kenya. As the fiscal agents, obviously they deal with National Treasury, but there's some luxury of time.
Folks, we've been having a conversation with Churchill Ogutu, economist from IC Group. Remember, the week that we are in is a heavy one. We're expecting to see the budget for FY 25-26, likelihood of supplementary 3, and also the report coming from the Finance and Planning Committee on Finance Bill 2025. That tells you this week we'll be entirely on our toes to comb through all the information, all the data, and all the numbers to be sure that we are making sense of all this and what it means for businesses and households. Stay tuned to Business Redefined for the breakdown as it unfolds.